Hey, welcome back to The Dive. Today on the show, we have the founder and CEO of X Out Capital, David Bars. David's joining us today to discuss why he likes Tesla, the security risks of TikTok, ChatGPT, and AI in general changing the structure of the economy, Netflix. He's also going to talk about some of the names that have been X'd out recently, the names he likes, and stick around to the end to hear David's market outlook for 2023. Hey, David, welcome back to The Dive. Thank you so much for joining us today.
Sandra, so great to be with you again.
Okay, so David, Tesla held its highly anticipated Investor Day. They announced a new Gigafactory in Mexico, but investors were generally displeased with the lack of new developments. Are you concerned at all that this might have a negative impact on Tesla stocks?
No, not at all. I mean, Tesla remains in the forefront of battery EV vehicles. And it's a technology company. It's not an auto company. People always want more from Tesla than they get, but Tesla continues to prove quarter over quarter that their focus on producing more vehicles and accumulating more data is where the value is for that stock. And it's a long-term buy and hold type of security, and our model gives it the kind of scoring that justifies it.
Okay, now Canada banned TikTok on government devices over security risks recently, and the U.S. House of Foreign Affairs Committee voted in favor of a bill that could give President Joe Biden the ability to ban TikTok. What do you think is happening here? Do you think that Facebook and Google may have lobbyists who are influencing policy, or do you think there's real concerns here?
I think this underlies the challenges that the Biden administration is having with China, and they look at TikTok as just a tool in their technology tool shed for accumulating data on American citizens, U.S. citizens, and that's really the motivation. I think their regulatory ire exists just as strongly for Facebook and other U.S. based technology companies, which is unfortunate. I think it's the top risk all those companies face. So I do think it's more of a China problem, not something that's being influenced, if you will, by any of the U.S. based technology companies.
ChatGPT is one of the most talked about themes right now. How closely are you watching it? And do you think that we're at an inflection point with AI technology?
Yeah, look, I think the last time you and I talked, ChatGPT wasn't even in our radar screens. Sort of hysterical now that this has become something that's at the forefront of every discussion. At least all the times I'm interviewed now, everyone wants to talk about it. I've been writing about it for over a year because it was curious to us that Microsoft, which is one of our largest portfolio companies, has been talking about the investments they've been making in ChatGPT. That's a telltale sign for what X Out, our strategy, is all about. We're about addressing technological change and avoiding disruption. Companies that aren't thinking about ChatGPT as a tool for the future and the way in which we operate our businesses are going to get left behind. Companies like Microsoft, which are spending heavily, which is a factor we use in our formula, which is how much investment are companies making in research and development. And ChatGPT was one of those investments. Now we're seeing it play out. So I'm very optimistic about the positive change it's going to bring to improving and addressing technological change.
When you think about the macroeconomic picture and the result AI could have on jobs, how do you think that AI will change the structure of the overall economy?
One of our factors, again, in our model is labor growth. So we like to see companies investing in labor growth. And if we're going to use artificial intelligence as a way to eliminate labor or replace it in some way, this is going to be an interesting phenomena that we're going to watch carefully and evaluate it each and every quarter as the numbers come in. But certainly artificial intelligence has had a lot of discussion going on about its use to replace physical labor. And I think we're likely to see that. And it does create economies of scale and efficiency in the way companies manage their money, manage their businesses rather. And those are the kinds of factors we look for in our models. So stay tuned. I think there's a lot we're all going to learn from our artificial intelligence and how it improves the way we physically work in our daily jobs.
We've chatted about Netflix in the past. Do you think that it's a smart move to stop password sharing?
Yeah, look, Netflix is dealing with their own disruption. They were the sort of first mover, if you will, in streaming. Now, every media content company is trying to develop their own streaming channel or streaming capabilities. And you see that probably like what your personal subscriptions look like in terms of how many different streaming services you now subscribe to. They're just trying to find ways to create better operating models for their business. I share my Netflix password with my family, but yet will likely be targeted as to confirm that that's truly a family sharing plan. And there are those who have a Netflix password and they share it with their entire fraternity or, a club that they're in. And so there are some, if you will, bad actors out there trying to get away with it. It's up to Netflix to figure out the right balance on how to let the service be utilized in an appropriate and proper way and maximize their own revenue base.
Okay, so let's talk about X out. Amazon has been recently X'd out off your list. Could you talk us through the reasons that led to this?
Yeah, so this is a big news for us. Since we've launched the fund and our strategy, which is over 3 years ago, Amazon had been obviously a perennial X in. It is and was a disruptor in many different ways, but now for the first time, its score in our model dropped below the line. So in other words, we value the 500 top U.S. market cap companies, give all of them a score, and then the bottom 250 are the ones we remove. Amazon came below that line. It was a combination of a number of different scores. We used 7 factors to establish a score. Amazon's score in revenue growth, labor growth. They've been obviously announced big layoffs like a lot of other companies have, but on a relative basis, theirs was larger and it impacted their score. They've also had some challenges as the new CEOs come in and we measure management performance. So a number of different factors came into play and brought it below the line. I think this is a telltale sign of something larger, which is Amazon got very big and a lot of companies are seeking to disrupt them and part of their ecosystem in different ways. And we'll watch this very carefully, but that's a lot of market cap for us to reallocate to the other 250 companies.
JP Morgan and Bank of America are also part of your X-out list. What factors led to their exclusion this quarter?
The major money center banks are in a challenging position right now. We're in a rapidly rising short-term interest rate market. They hold lots of their capital on deposit and currently are challenged with what to do about their net interest margin. That's impacted their revenue line in particular. But I think more importantly, the banks are just not making traditional loans like they used to. That market has been disintermediated by the private market. So because banks were trying to keep their balance sheets clean and address a number of the concerns the regulators had with having super strong balance sheets to protect against market cycles, like what happened during the financial crisis in 2008 and 9, you're seeing the disruptors being the private credit market, taking those loan book opportunities off of the balance sheets of the major banks. And that's impacted their performance. And that's why they're being X'd out. I think as interest rates normalize, hopefully their operating environment will normalize and those companies will continue to perform well again. But if you're not getting paid any interest for your deposit at a big money center bank, why would you keep it there? Wouldn't you move it now, especially if you can get the U.S. Treasury for 3 months for over 4.5%? Boy, we haven't seen that since before the financial crisis. So banks will need the market to reset before they can start to figure out how to better compete for capital.
We've seen the tech industry has experienced a large number of layoffs recently, but you still have Apple and Alphabet on your top 2 fund holdings. Why do you like these names?
Yeah, so again, just as I answered the question about Amazon, they're all addressing their operating expense line in their income statement. Companies are figuring out ways to deal with the current environment and continue to generate strong revenue growth, but also profitability growth. And some companies have done it better than others. Amazon's labor growth reduction was more impactful to the way we evaluate it through our model. Apple and Alphabet have done a better job at doing that, even though both of them have announced labor force reductions. So it's all about how each individual company is dealing with this new normal, if you will, this environment where inflation is causing a reset in the interest rates of fixed income instruments and how expensive or not capital is. So you do that through managing expenses, and some companies have done it well, others haven't, and the score reflects that. But our model still loves Apple and still really likes Alphabet.
Okay, so David, before we let you go here, what is your market outlook for 2023? And are there any companies that you expect your model to X out this year?
So we continue to be optimistic about the future, even as inflation is resetting the rates paid on fixed income securities. There's always been a balance between what you allocate to equities versus what you allocate to fixed income. And for the first time in many, many years, we're seeing a normalization of what might one refer to as a 60-40 balance. That's 60% to equities. We're in the equity bucket, and we've been long-term optimists about equities, and we've been constant repeaters of the fact that technological change is a significant forward-facing risk. And our strategy seeks to address that for you in a diversified approach where you're owning 250 of the 500 largest U.S. market cap names, and you're able to eliminate, which we think is easier to do. It's easier to eliminate the companies that are going to get disrupted than it is to try and pick the winners. Strategies like ARK are trying to pick winners. They're trying to pick innovators. They're trying to pick those companies that they think are going to change the future. And we see how hard or volatile that kind of strategy can be. Ours is a much simpler approach. Just be diversified and look to eliminate those companies that aren't going to be able to address technological change. And to your second part of the question, we continue to see, which is going to not make your Canadian viewers that happy, the energy market is a place that's tough to be. The ability for those companies to continue to grow as the commodity price sort of settles in. They were able to achieve massive profits in 2022 because the commodity price increased, but there wasn't the same level of capital expenditure going into exploration and production that had historically been the case. And that's in part due to the regulatory environment. But we just continue to see those companies are going to be a little challenged and are likely going to be X out candidates in our portfolio as we go out into the future.
Okay, great. Well, that's all we have for you today, David. Thank you so much for coming on and sharing your expertise with us and our audience. To our audience at home, thank you so much for watching today. We will be back again tomorrow with another great interview, so be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.